This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro. What I'm going to do today is talk about average true range. And what I want to do on this video is really focus in on what I talk about on Friday with the relationship for the market. I use it as a surrogate for the VIX, okay? I don't want you to use this approach on individual stocks. I don't think it applies the same way. In fact, in periods I'll show you in this video where we actually are looking for lower volatility basing patterns in stocks that show a volatility increase. Okay, so it's a little bit different when we're looking at it from a general market standpoint. I'm trying, and I'm going to show you exactly how I would go about using it and what ATR is. But I wanted to make that distinction. I don't want you to just start applying it randomly to everything. All right. There's a lot of great uses on a bottom-up stock by stock basis. I use it to help with stops. I use it to help with targets. It can be really powerful from that standpoint, but I am going to focus mostly on where the risks increase and decrease, and a different way to use this indicator, I think, than something like the VIX. All right, let's get into this. I do want to apologize. I'm down in Florida for the month, and I know the background here is a little distorted with the, but it's way too bright behind. So I'm trying to get the sun out. Hopefully it looks okay. Anyway, let me take this off. Let's go ahead and look at the S&P. And so the first thing I want to do is explain what ATR is. So the average true range is so let's look at this as an example. Right here is the close on this daily chart. Okay, this is the close of this candle here. So that's the close of this day. Here's the low of the next day. Okay, you see how there's a gap in between? Now, if you look at the range for the day, you would say this is the range. You see how that's the high and that's the low for that bar? But when you look at average true range, you go by the prior day's close. So it is including the gaps in the range. So you see how the range is different when you look at it from an average true range? So if you're looking at the average true range, you're giving it the entire move from the prior day's close instead of just looking at it from the current bar. And what that does is it tells us what's really going on in terms of volatility. You can see that the size of this bar is actually a lot bigger when you include the gap. So when we start to think that way, yeah, you've got a big bar here that would have been included in a regular range, and that's also the average true range as well. This is also included. So I just want to make sure I explain that so you understand. Now, what takes place with this is it will go through periods, and I want to zoom out because I want you to see how you go through periods of massive expansion in volatility that goes, kind of crazy, like what happened in 2020. And same thing that happened back in 2008 with the massive decline. You see the volume. So you can look at a daily chart and you can see, and I recommend using the daily over the weekly. The weekly is a good supplemental tool, but I really started using this with the daily chart. I have more history with the daily. I think it's more sensitive. And I do believe it's going to provide probably better signals for the most part. So we want to be aware of that. We can see some things like, look at what took place here. We had this low ATR for an extended period of time, and then we basically broke out to the upside. You see how that took place here? So that was right before we went through this massive downside move in the market. And yeah, this had rotated around. There was a lot of volatility, but the general trend was higher highs and higher lows. I mean, we had a kind of a deep pullback here, but in reality, if you're looking at it like this is a breakout play, right, and you have some volatility, you had a correction in the uptrend, and then you made a big spike move, right? And then the spike move is followed by a divergent bottom. So we went to a new low. Here, price went to a lower low in early 2009, and this did not confirm. The volatility did not spike again. That was a really good signal. Now, I can tell you, I remember this crystal clear. I sent out to my institutional clients, I sent out a list of MACD divergences on the weekly that they were everywhere off the low. It was one of the best MACD divergence signals for the general market that I can ever remember. You want to kind of just be aware that what happens is the volatility will increase before we actually hit. So look at how this moved up before we got the drop. You see how we got this move to the upside? If I make this a straight line, this had already turned up above its moving average before we got the drop. You see how this turned up, made the higher high and higher low here, and while this was topping out during this phase. Okay, and then again at the looking at the bottom, when this makes a lower low, we kind of had already peaked and started to roll over. Okay, so I've just found this to be a really useful tool. So you can go through these yourself if you want, but in most cases, so if I look at this pattern right here, you see what happened in 2020. You see how the volatility increased before it peaked. You see how we had to move above the moving average, and the moving average was rising before we got the drop. So, I mean, again, I'm not, and then the same thing happened here before this last bear market. So if this is the peak here, look at what the volatility was already doing. Let me make this a straight line. Actually, let me do this. I'm going to get rid of this. Let me make this easier. Look at that. You see how this had already turned the trend? This had already broken the downtrend. It came down into this area and then turned up and gave a really nice early warning sign before the new year. Anyone who was watching my Friday videos would have seen that this was a really good signal. We had early warning signs both on the daily and the weekly. So we've got kind of the reverse taking place here, where we went to a lower low and this did not confirm. We are moving up and this is moving down. Now, this has started to tick up. We have to see if we start to get more volatility. Does this turn up and break its downtrend line and really start to turn things around on a daily chart? Then the risk really starts to increase dramatically. So use this to your advantage. I know a lot of people use the VIX, but I have not been able to find a way to use technical analysis on the VIX. I don't find it to be a useful tool in terms of applying anything. I can't get anything out of it that seems to be consistent. I know the levels on that, I guess, can be important, and guys have studied it for a long time, and I'm not saying that it can't be used. I'm just saying for me, it wasn't something that I found fit into my approach in a way that I was comfortable. So I ended up landing on this, and I use ATR for everything. I use it for stop placement, as I said, or at least to help with stop placement. And that's a part of my course as well. And then I also use it because of that, because I'm using it for stop placement. It also helps with targets. So use the stock's own volatility to your advantage. And also be on the lookout for if you're looking for a basing pattern, okay, you want to find a basing pattern in a stock. You want it to have a historically low volatility period before it takes off. Okay, so you look at that daily chart and it should have so if you're looking at a basing pattern like this, while it's down here, you want this ATR to have come down as well and be low as well. You want a low volatility period to coincide with the base. And then once it starts to move, the volatility will actually expand. It's a little contrary to what I'm saying, but the trend of this, the bigger trend of this can go counter to what I'm talking about in terms of these signals. But the intermittent swings are what's really key. So these swings are what's really important to what I'm talking about with the S&P. It's not necessarily going to give you a big long-term trend analysis, okay? It's more used for what's taking place, is there risk right now, and then it alleviates the risk. In a lot of ways, it's very much like the VIX from that standpoint. It's not like you can use the VIX from a longer term trend standpoint. All right, so hopefully this helps explain why I bring this up and why I think it's useful. All right, thanks.